Morning to everyone listening in. um, the topic today is, well, we thought, Doug always asks, can we give a nice, interesting topic? Today is definitely a move back to normal. And I've just been reminded the last week or two, going into the office, traffic is definitely back to a lot more normal than it used to be. So I think, economies are opening up. Yeah, so today we'll touch on a bit of that. We'll first quickly just have a look at the fund. Doug touched on how the fund is done fairly nicely. Maybe we look at a bit longer, slightly longer, more longer term, over 1 year, 8.8% for the fund. And if you look at that, a big contribution of that over the past year has been SA bonds. Now, SA bonds, that captures quite a few of our bond categories like inflation-linked bonds, convertible bonds, floating rate bonds, or nominal bonds. So quite a nice contribution across the board from a multiple investment buckets, if you would say, or investment asset classes on the income side. So quite a nice distribution on that. For the quarter, I think quite an eventful quarter. I think you've all heard from maybe a couple of speakers, whether it's the Fed that wants to taper, or energy prices shooting the lights out, or Chinese regulation. All of these things impacted the quarter. And so actually the quarter, if you look at that, nice contributors from actually inflation-linked bonds, and then a weaker rand. So we do have some offshore exposure, which actually contributed nicely for the quarter. Overall, I think a strong quarter. We've had a good year. So I think the challenge is, like I said, in investments, it's always forward-looking. You can't enjoy the more recent performance for too long. Just on the what we do, that approach, like always, it's about a diversified alpha approach. I'm a strong believer that if you look at income funds and you look at what we've typically in diversified funds, and especially income funds, you want to have multiple opportunity set, or opportunity set where you don't just look at bonds, you look at money market, you would look at yield curve, inflation-linked bonds, currency, and so forth. So this approach to try and look for cheap assets across opportunities, it just gives you a better probability of success. And I think in this day and age where South Africa is a small open economy, having the opportunity to invest offshore, I think is quite important. So I think this is, we've mentioned it a couple of times, the ability to invest across multiple income asset classes is quite important for the fund. And that, keeps us busy on our daily basis. Quickly on the global backdrop, let's just set the scene. We have talked about the Fed came out and said, listen, we are probably going to start tapering in November. And why is that? Now, let's just have a look at, we said we in the process of slowly normalizing. Normalizing, we'll never get back to the, what we were pre-COVID fairly quickly. But if you look at the US and you look at US GDP is just about recovered to pre-COVID levels. If you look on the left-hand side, that graph, with that you can see the US unemployment, which has fallen very sharply. So I think the Fed, with their mandate of, price stability and employment, full employment, they are getting there, and they've made great strides and actually fulfilling quite a bit of that. And Jay Powell has basically said that, listen, we will start tapering. I think the problem for the Fed is where they will definitely start is you look at US CPI, over 5%. And when, I can't remember when it last time was, but you look at SA domestic inflation and US inflation is the same thing. So I think this idea of inflation being transitory, I think more and more the evidence is that it's not as transitory as they think. And that's been also the theme for the quarter. I think this concern that, high energy prices, supply chain bottlenecks, etc., is causing a lot of inflation. And in the US, you had things like second-hand truck prices, healthcare, etc., just contributing quite significantly to inflation. So long story short, I think we are definitely going to see tapering. The 120 billion asset purchases from the Fed will definitely decrease. I think the question now is the pace of how this will happen. It is a delicate policy balance, because if you look at now a number of forecasts, GDP, GDP is rolling over. So wherever they had a fantastic rebound in GDP, global GDP, and the US has been on fire, but projections are rolling over for a slower growth. We've had words of people calling, stagflation is the new buzzword. I do believe the inflation part of it might be a bit of a concern. I think, being too concerned about growth just yet, I think we could probably have a bit of time on that, but it is a concern. And also, if you look at the change in money supply there on the right-hand side, stimulus is basically withdrawn. And like I say, the punch bowl is slowly being taken away, and that can create volatility and issues in asset markets. So there is this policy balance where the Fed and global central banks will need to start cutting stimulus, withdrawing stimulus from the market, but there's also the slowdown in growth and money supply that we've seen. So definitely back to a more normal kind of stimulus and money supply and the likes. If you look at on the local side, local inflation luckily has not been an issue for us just yet. I think the SARB has managed to anchor our inflation expectations. I mean, you rewind a couple of years ago, it used to be 5.5%. That's what we were used to. I think they've made fantastic progress in anchoring our inflation expectations at 5 or even lower. And they have said targeting the midpoint of 4.5. Locally, inflation has not been a big issue, but we have seen, if you look at the right-hand graph there, just the Rand oil prices, it's at levels we haven't seen for, many, many years. And it's still going up. So that is a concern. That is inflationary. It will probably add anything between 0.2 and 0.4% to inflation. So the pressure is definitely building on the Reserve Bank to start our hiking cycle. Now, if you look at global policy real rates, we are lagging some of our peers. The likes of Mexico, Russia, Brazil have all started hiking cycles. They have had more of a inflation issue to deal with. But we are lagging our peers. As you can see there on the left-hand side, we are having negative real policy rates at this point in time with inflation about 5, repos at 3.5. So I think the pressure is building. This with the higher energy prices where we are net ex importer of energy. Then you look at the FRAs. We were fairly, more relaxed on mid-September. You can see the last month how FRAs, these are forward rate agreements, which kind of just tells you what are the path of policy rates, where now it's becoming quite apparent that the market is expecting, rate hikes in the next couple of meetings, at least 25 bips from November going into next year. So rates are going up. That is a foregone conclusion. The only question is, how quickly rates will go up over the next year. We think it should go up probably at least 125 to probably 175 basis points. So what does that mean? So ultimately, a lot of this volatility we've seen over the quarter gives us an opportunities to do things. Our bond yields have spiked and has gone up quite a bit over the quarter. And what you can see there, our yield curve. So what we've done here is just give you an idea. We like bonds at this point in time. The SA 10-year bond is probably trading at about a yield today of about 10%, where it used to be about 9.23 not long ago. Now, if you look at our bond valuation, how do you determine this? You can break it down into the US, into a real rate of the US of -1, inflation at about 5, you add a bit of an inflation risk premium, and then you get to what's the implied SA country risk premium if you've got a 10% bond yield, and that's about 5.6%. Now, we think that should be closer to 4 and 4.5. So we do think at this point in time, you're being compensated to add nominal bonds. So to make a long story short, we like nominal bonds. We've added duration to the fund. We like the belly of the curve, which is kind of that 8, 9, 10, 11-year area of the curve. On the front end of the curve, we like inflation-linked bonds. Quickly moving on, I'm not too sure how we're doing for time. I'm sure Doug will, help me and warn me. But we're just about there. If you look at the rand, our fair value for the rand is, if you look on the left-hand chart, it's about 14 rand 70 on a PPP, purchasing power parity basis. If you do a fundamental adjustment, I think, we think we're a lot more comfortable as a fair value of around 15.50. We have seen the rand actually finding quite a bit of support. But here's the thing. Our terms of trade have been very favorable. We've had revenue overruns, commodity exports doing quite well. So actually, we got a bit of a jail out of free card on the commodity and export front. But if you look at our current account, and you can see on the right-hand side is just a forecast, the SARB forecast of our current account. You can see how a current account surplus is actually going to go into deficit. So some of these, let's call it tailwinds for the rand, I think is going to reverse in a more neutral and even headwinds. So we do think the rand will probably trade weaker into next year. So that's just quickly on the rand portfolio overview. We're just about there. Then, Doug can ask me a few difficult questions. Just quickly on the positioning of the fund, our focus remains diversification, trying to identify, attractively priced income assets while trying to avoid the more expensive areas of the income. At the moment, the fund yields about 6.1%, total duration of 1.4 years, of which 8.8 is nominal bonds. The balance inflation-linked bonds and offshore. Our effective offshore currency exposure is 8%, which is a bit of a natural hedge against the nominal duration. So there is a bit of an offset there. If you look at the exposures there on the right-hand side, you can see there, I'll quickly scan through it. We've still got a bit of property exposure. We have taken a bit of profit on property the last quarter. Healthy offshore exposure, and we'll touch on that in the Q&A, I think. Inflation-linked bonds, fantastic diversifier at nearly 15%. Floating rate notes, I think I'll just stop on floating rate notes. This is the one asset class. If you look at the whole portfolio, nothing of that will reset when rates go higher. Our floating rate component, obviously, as the repo rate and JIBAR goes up, that will reset. So there, I think over the next year will be a nice windfall, if you want to call it that, from that component of the fund. Thank you.
Thanks, Philip. Yeah, it's always, I think, interesting to hear your views. And one of the things I always have not debates or discussions with Philip is about is I always want to talk about the macro elements to it. And Philip is constantly bringing me back to what's the valuation and how does it fit into the portfolio. And that certainly speaks to the approach that you take and the approach that you apply to the fund. And you did touch on this, but I want to really reiterate it. There has been a lot of macro news. You've gone through Fed tapering, and 2014, not that long ago, 2013, not that long ago, where we saw, a Fed hike rates or indicate that it was going to stop its quantitative easing process, and this did have a big impact on bonds. And so, and in particular, SA bonds. We've obviously had Evergrande coming out in China, which has obviously been a news flow as well. And there just has been a lot of macro news. And how are you guys, with all of that news in the space, with all of that news in the market, and with, I guess, the projection for higher inflation rates, both globally and probably locally as well, are you guys comfortable with that valuation at a premium of around 6%?
Doug, yes, I think what we have seen the last quarter, like you say, we actually enjoy a bit of volatility because I think volatility gives you opportunities, to buy and sell asset classes. What we've seen the last quarter is our nominal bonds, becoming a lot more attractive, probably by close to 1%. So yes, on your question, we do take cognizant of the macro issues and you look at inflation, you look at tapering and the effect. Just to back on tapering, I think the Fed and central banks have done a lot better job this time around to communicate and to be clear. So hopefully we won't see, a repeat of the taper tantrum, in 2013-14. So I think hopefully a bit more stability, but I do think markets, and especially equity markets, I'm not too sure whether all of this is being properly discounted. The withdrawal of stimulus, a reduction in money supply, elevated valuations. So maybe a nice diversified income fund is not the worst place to be. But valuations, as we've touched on, I think, bond yields at these levels, you are being compensated for the risk. If you look at our debt to GDP, we, you rewind 6 months ago, I think we thought debt to GDP will, peak at about the mid 90s, low 90s. We're now talking about a high 70% debt to GDP. So from a fiscal side, it's looking better. We will wait for the MTBPS and just see, hopefully we get some good signs that fiscal consolidation and a conservative approach, is at the order of the day.
Not moving to local sides yet. We had a really good question coming in just around, I guess, if the Fed does start to taper and you do see monetary policy normalize to some extent, there's been the US debt levels have been quite high, and there's been a lot of talk about raising its debt ceiling to fund some of its obligations. So do you think that in this environment where they actually do start to, or where I guess this monetary policy is replaced by fiscal expansion policy, do you think that there is still room for that to happen without negatively impacting the market?
I think so. I think the market has discounted some of the fiscal stimulus and packages, maybe not all of it. That's obviously good news, I guess, for commodities on the margin. I think the dilemma at the moment is, I think you look at the Fed and monetary policy, and I think they need to tighten monetary policy, and hopefully they will balance this with, more generous fiscal spending where these programs have been announced. So I think a delicate balance where you want to keep growth going, but, on the monetary policy side, QE and the likes, they will need to start, pulling back on that. But hopefully the slack will be taken up on the fiscal side, fiscal spending.
And there are, I guess, turning back locally, there are, I guess, expectations for higher levels of inflation in South Africa, or to start to increase somewhat. You did have a slide there on oil prices.
Yeah.
And I guess that could feed through to higher inflation locally. Could you just remind us again about how the fund is positioned for that type of environment? And then, if you, in answering that, if you could also just touch on some of the SARBs, increases to interest rates and how the fund is protected from that perspective.
So I think, again, as we said, I think that's why it's so important being able to, you've got lots of types of income funds. These kind of funds, which are more diversified, I think, just gives us so much more opportunities and tools to capitalize on certain things. So you look at high inflation. We've got inflation-linked bonds in the fund. We've actually reduced a bit of that. We bought quite a bit last year. The real rates have come down, but we still have a healthy allocation to inflation-linked bonds. So with an increase in inflation, you should be able to get a benefit in the inflation-linked bonds. Now, typically, if you look at a SA Inc. sell-off, both nominal bonds and inflation-linked bonds will sell off at the same time, if it's a South African-specific issue. What we have seen this last quarter is more inflation issues. So nominal bonds had a poor quarter, but actually inflation-linked bonds did fairly well. So that diversification is working nicely. And then the other component that will do well when rates and inflation go higher, and I'm assuming that, when inflation goes higher, SARB will hike rates and, honor their policy, which they've been good at. Then your floating rate component, which is about, at least 35%, will start to reset higher. So those floating rate components, just to remind everyone, they are linked to JIBAR. And as your repo rate goes higher, JIBAR goes higher. So that whole floating rate component will float with rates and it will reset higher. So that yield will go up over the next year. So nicely, having the ability to invest in inflation bonds and floating rate notes is a nice advantage.
We have a small position in preference shares in the flexible income fund, and this has always generated a healthy yield. They have come back quite nicely, but there has always been this expectation that banks will eventually buy them back and replace them with some of the, I guess, the tier two type instruments. Nedbank have recently issued a SEN statement. They want to buy their preference shares back. Are we expecting to see more of this? and what is your indication for how this could impact the fund?
Yeah, Doug, actually a nice surprise. You know, preference shares have been one of those asset classes where we've had some exposure. We decided to keep it because of, I think, firstly, they're not as liquid, but also gave quite a nice generous yield of, anything between 8 and 9% and before dividend withholding tax. So quite a nice attractive yield. But what has happened, I think it was in 2013 when we adopted I think it's Basel III, they gave an indication that preference shares will be phased out from 2013 to 2023. So actually, it seems like at 2023, preference shares, if they're not bought back, the banks will get no capital relief, or it won't, count towards the capital adequacy numbers. So I think what Nedbank has done makes a lot of sense. I think the other banks will follow. We've already seen a lot of the preference shares, re-rate and having decent performance. Nedbank, in the sense, I think they indicated that they're going to buy it back in the high 90s. A lot of these are still trading in the, around about 80 cents. So I think there's maybe a bit more uplift if these banks come to buy it, and that's more or less, I think, is our expectation. So again, not something we counted on, but we knew at some point banks will be forced to, or not forced, but there's a high likelihood of that they will have to come and buy this back because of the way these preference shares are accounted for on the capital side.
Very good. Going back to offshore quickly, you guys did a really interesting trade, and this is something I was speaking to Phil about during our recent due diligence with him. And he explained how he had instituted a swap structure, particularly currency and I guess interest rate swap structure at the same time. And I think this is a really good example of how you've used, I guess, a non-traditional way of generating, I guess, returns for clients offshore in a very conservative and risk-considered way.
Yeah, Doug, it's an interesting one. I think having the ability, like I said, so when people say the ability to invest offshore, we always think, you invest in dollar or euro assets, and hopefully the rand weakens, because if it doesn't, you're only going to get your maybe your 1% of offshore yield. So I think people are always counting on some rand weakness. So we also have at this moment an 8% effective offshore exposure, but our offshore assets is actually quite a bit more. It's closer to 20%. So how does this work? So what we've done is, if you've got, let's say, 10%, let's take the example, you invest 10% of your money offshore. I'll use an example like Bidvest. Bidvest issued an offshore bond yielding 3.5% over 5 years. That's in US dollars. What we then did is, if you were to hedge that dollar return back to rand, the implied forwards, whether you do a swap or whether you do currency futures, the implied funding rate there is quite high because of a few issues, which maybe we can discuss later in it. But it seems it's got to do with, the SARB and sterilization of certain loans where they need to do some counter transactions. But a long story short, so the implied funding rates or forward rates is quite high. So if we take and we hedge back that dollar yield back to rand, we get the 3.5 plus at this point in time about 5%, 5.2%. So you're looking at a yield of about 8.5, 8.6, 8.7%, which is a lot more attractive than you can find in the local market. So having the ability to take advantage of certain anomalies like these implied funding rates, you can get quite a nice yield pickup when you convert some of your offshore invested debt into ZAR rand denominated debt. So hopefully I've explained that well enough. It's not that complicated, but it's not that common. So again, this diversified approach, being able to look at different asset or income asset classes, gives us quite a bit of levers and tools we can use to enhance yield.